Joining us now on the Megacast is Jason Brown from the Brown Report, as we are joined by him for our market talk, as we're in an interesting time once again in our market as we continue to deal with inflation, but now in kind of a different way where we're starting to see little bits and pieces of relief in the market and with inflation's impact on the economy. And so, Jason, as we bring you in, what should we be considering in this regard, as it relates to where the market is at right now and where the economy is at in particular in relation to the market?
Yeah, so thanks for having me on. I think there's a few things that are interesting that are happening that we should be paying attention to. Number one, I filled up for gas the other day. I put premium in my car, and for the first time in a long time, I paid $3 and I think 59 cents for premium, which is down from about I think I paid somewhere upward of 5.40 in the past. I mean, so that's a big drop in prices of paying for gas. So you can start to see some of the things are coming down as far as price wise. The thing I'm not seeing come down yet is food prices, but I think that's going to self-regulate itself because as food costs continue to go up, or at least as people are charging more for eating out at restaurants, people are just going to decide to stay home and cook, and I think it's going to force them to bring those prices down, even if it means bringing them down to break even so that they can move the product and that people can feel comfortable eating and shopping again. And then today we had the CPI report come out. If you don't know what that is, that's the Consumer Price Index. It basically measures how much consumers are paying for goods. Is it, inflated, or is it deflating and coming down? And that report came out cooler than expected, which means the numbers are starting to come down a little bit. And it just makes sense. Prices can't keep going up forever. They eventually plateau. And then as demand drops, they start to come back down because people need to sell what they can to keep their doors open, even if it means taking a less profit or, again, just moving the product off their shelves. So I think people can take solace in knowing that to some degree things are getting better, or at least there are signs that things are getting better. But it makes sense because bad times don't last forever, whatever those bad times are.
And it's interesting too because the Federal Reserve has, throughout this inflation crisis, continued to raise interest rates by about 0.75% a month after month. They've done it an unprecedented number of consecutive times, something we've never really seen in the past, or at least in the history of the Federal Reserve. And yet, despite those tactics to combat inflation, the U.S. jobs report remains very strong. Employers added 263,000 workers just in the month of November, that according to an article from the New York Times. And so, how does that also playing into how companies and their standing in the stock market in particular may be impacted, considering that the cost of these jobs maybe isn't having as great of an impact as we might have thought would be the case given the state of inflation?
So, yeah, a couple of things you just brought up that are super important. As Fed raises interest rates, really it affects purchasing, houses, it affects purchasing cars, it affects mostly your big purchases. So, if you go to the grocery store and you swipe your credit card, paying an extra 1 or 2% in interest, assuming you carry that balance over every month on $100 worth of groceries, isn't gonna affect you that much. But it is gonna affect you once you buy a $50,000 car. It is gonna affect you once you buy a $200,000-300,000 home, and you're paying that higher interest rate, and you're paying it for a longer period of time. And so what it's doing is making companies rethink about equipment they need. Do we really need this building? Do we really need this many employees to finance the expansion of that building? Because that's all going to cost us a little bit more money than it used to cost us. So it's going to curve, from a consumer standpoint, it's going to curve the appetite for buying cars, it's going to curve the appetite for buying houses. And we've seen kind of that market come down. And then on the business side, it's going to curve the appetite for expansion because companies don't want to pay a high premium to expand when people are starting to pull back on what they're purchasing. Now, On the employment side, if you think about it, when COVID happened, you had a lot of people exit the workplace. You had teachers that exited the workplace just because they were burnt out. You had nurses that exited the workplace, and then you had a ton of retirees, or should I say, people that were thinking about retiring, go ahead and put their hat in the ring and say, it's time to retire. And so the baby boomers, that whole generation was the biggest population during that time to work. So they're also going to be the biggest population to exit the workplace if they've just been hanging on just to have something to do. And so we still need people to come in and kind of fill up those jobs. So the unemployment rate is not because people I don't think it's because people don't want to work. I think it's because we had so many people exit the marketplace that we don't have enough people to fill those jobs. And so as they raise interest rates and companies say, how can we cut costs? Maybe we lay some people off, maybe we don't expand. The goal is for people to go in and fill up those jobs. And I think that's why they're saying, when I say they, the media, is why they're saying, we had an official recession. The definition of a recession, which I think is super funny, the true definition of a recession is 2 negative quarters of GDP. We had 2 negative quarters of GDP. No one wanted to call it a recession. They said, why not? And they said, because we have so many job openings. And so now they're saying, well, the real recession is coming next year. Well, what is the real recession if there's so many job openings and inflation is coming down and maybe we won't have negative GDP? So I don't know if that's a fear tactic or they just don't want people to panic. And then once we get out of what technically should be the real recession, they're going to look back and say, oh, we were really in the recession, but they didn't want to call it that because they didn't want people to panic. So I think the job openings have created a floor to where we don't have to worry about people losing their homes and the economy exploding because there's so many jobs out there that you can go get to keep that from happening. So I don't think there's as much to worry about as the media may be playing it up to be. And as not just the media, but as the Federal Reserve may be playing it up to be. But I think that's part of their job to get people to hold on to their cash and stop spending so that inflation can come down. And if they're sitting on the couch thinking, should I go get a job? They want them to get off the couch and go get one. And I think a little bit of, I won't say fear, tough talk will encourage people to do that.
Jason, we are experiencing just a little bit of a technical issue on the backside of things here. We'll take a very short break. We'll come back and we'll continue on and talk about how all this really applies to individual consumers and families at this moment in time, what they can do in the market to put themselves in the best position right now and in the future, given what information they have at this time. That's going to come up in just about 30 seconds to a minute. We'll take a break very shortly here on the Megacast. Welcome back to the Megacast. I'm Tyler Kieft. Of course, you can learn more about our program, keep up to date, and find us on demand on civiccentertv.com/Megacast. Continuing on with Jason Brown from the Brown Report on today's edition of the Megacast. Jason, as we talk about where the U.S. economy is at, kind of the negatives that we're hearing about, the positives that we're seeing, how those two relate, how they kind of contradict each other, that creates, I would assume, a lot of uncertainty for the average consumer in the market as they're trying to make decisions about where to put their money, when to exit the market in certain places and take their out, where they'll put more money in and invest a little more in what could happen in the future of the market and bring them some more gains to their portfolio. So with where we're at in the market at this time, with where we're at in the economy, given the impact of inflation, seeing the jobs report from last month, even just yesterday, reports coming from the Wall Street Journal that the Dow closed 500 points ahead of the CPI report. All this coming together, what does that mean for the average consumer, and how should they be approaching their place in the stock market at this time, given all this information?
I think the average consumer, being that they're average, they probably just get their information, from the news. And so they just wake up and say, oh, is it good or is it bad? But if you go a little bit deeper, the market is forward thinking. And so the stock market doesn't just take news for today or whatever the report is today. The stock market says, okay, we know that at some point inflation is going to come down. We know at some point people are going to fill in these job openings. And so the market typically bottoms ahead of the general public getting that information. It's not till they look back and then the news finally say that was the bottom, but the market starts to come in early in anticipation that things are going to turn and get better. And like I said, the CPI report came out today. Inflation's a little bit lower, or they call it cooler, but means it's dropping a little bit. And so I think people need to start thinking about the market as the worst. I shouldn't say the worst time to buy, but do you want to buy when things are at its most expensive price or at all-time highs? Because then it can fall pretty hard. But after it's already fallen, about 50%, which is what some of these stocks have come down to, it's unlikely that they're going to fall another 50% or go down to zero and go out of business. Amazon, Google, the Teslas, they're still selling cars. People are still running advertisements. People are still shopping on Amazon. So there's a floor where they still have some value. And I think consumers or the average investor needs to start looking and saying, what stock can I start to move into, or index funds or ETFs that I know these companies will be around for a long time, and they've fallen some, but they also have the biggest to rebound. And so I think they need to start positioning themselves to be ahead of the rebound versus you hear people who say, I pulled all my money out because I kept hearing recession. I was scared. Pretty much right around the time when most people do that is where the bottom hits and then the market turns around. So don't panic. You've already sat through the pullback. It's more likely that we have more room to go up than we do to go down. And that's what I want people to be thinking about.
So Jason, in those kinds of situations, for your clients at the Brown Report, as well as those that are listening to your podcast, the Money Mindset, a Markets and Mindset podcast, across all different platforms, how do you help them balance that difference between being, worried about where the economy is at, where their money is going to be in the market, and how that's going to ultimately affect their bottom line, versus using the market to their advantage and positioning themselves in a way that is, as you said, forward thinking as the market tends to move?
So, first, worry comes from lack of information. And when you don't have information or the right information, you have all these what ifs, what ifs, what ifs, what's going to happen. And so, the first thing I try to do is break down, historical numbers and, the truth in the marketplace. And if you look back over history, it doesn't matter what recession, depression, 9/11, pandemic, long term, we go higher. So if you can just at least grasp that concept first, that long term we go higher, that removes some of the short term worry. Second thing is when you look at the charts, if you start to read stock charts, you look at a company like Amazon. I have my chart up here. It was trading at $190. It's now trading down at $93. To be able to buy that stock $100 off, very unlikely it's going to fall in half again to a down to $50 off, right? That means it fell 75%. And so when you think about understanding that they still have a business, they make billions of dollars, they have Amazon web servers, they have, they're shipping and shopping, they still generate money. So that removes the fear of saying like nobody's shopping right now. It's like, no, just maybe people aren't spending as much, and that's already been accounted for in that 50% drop. So just helping people understand the numbers and the math. And then the third thing is understanding that there are strategies to protect your account and make money when things are falling. So you don't have to be nervous and you don't have to panic. You could deploy some of those strategies that is like insurance for your account. You can buy put options that say if the market falls, I will not lose any more money than this, or I will have locked in my gains. And so those are the three ways I try to help people understand the historical data, finding good companies, understand they still do normal business and that they're not going to zero. And then number three, understanding the strategies that they can deploy to protect their account and grow it, even if things start to deteriorate a little bit more. But how much more could it deteriorate? We've already accounted for that because the market is forward thinking.
And as you said, and as other experts that we've talked to in this regard, and economists have said, given that we're in kind of a downward time in the economy and in the markets, it is a good time for people that are entering the market for the first time or considering entering the market. It's a good time to get in and to make those investments while these prices are lower than they typically have been in the past. And so, Jason, for those that are just getting interested in entering the market or just about to start putting some money into the market and investing, what are those what are the two most important things or most important pieces of advice that you would give them as they're starting today in this situation we're in right now?
So the first thing I would tell people is to think about your goals because that's going to direct how you invest or trade. And what I mean by that is if you're investing for retirement, then it's a different time frame. You got 20, 30 years. And like we said, the market goes up over time. You can just go with an ETF like the SPY that mirrors the S&P 500 and just say, hey, over time, the S&P 500 returns 11 to 13%. I'm just going to park my money there and I'm going to, continue to fund it or fund my 401k or my IRA, and I won't look at it for 20 years. So if that's your goal and then you understand that time frame, it's a great time to get involved. The second thing I would tell someone who's just getting involved right now is if you really want to take this kind of into your own hands, start to look at some of the companies that you do business with. You do business with Target, you do business with Amazon. Maybe you have an Apple iPhone, maybe you have an Android phone, you use Google. Maybe you buy makeup from Ulta if you're a female. Ulta has been on a tear. And so look at some of the companies that you do business with and then learn how to read stock charts or at least understand if it's in an uptrend or a downtrend. And then start to invest with an amount that you're comfortable with, that if for some reason you're just 100% wrong on this, at least you're in the game and you're starting to learn. So those are two um, types of individuals I would speak to and two different insights I would give them. If you're investing long term, just know the market goes up long term. And if you want to take it into your own hands, but you don't want to blow up your account, maybe you start with $500 or $1,000 and see what it's like to own a piece of the companies that you already do business with and get into the rhythm of seeing how does this stock move every month or 6 months to see, can you catch the rhythm of knowing when it's going in an uptrend and when that trend is over and it's starting to come down.
Good place to go for advice and other information as you're beginning your journey of learning about the stock market and investing is thebrownreport.com. You can also listen to Jason's podcast, the Money Markets and Mindset podcast, and find more info on thebrownreport.com as well. Jason, thank you so much for joining us.
Tyler, thanks for having me. Always a pleasure.